All right. Yes. So good evening, everybody again. Welcome to the last lecture. I think we have quite a bit of people already, so let's kickstart today's lecture. So I do see a few questions, whether number one, we can go through a quiz and whether we can go through the GBA. So let's for the quiz, so for the quiz, unfortunately, I reach out to the school. We are not able to go through the answers. And I think one of the more what's called operational reason is that because some of the questions might be repeated next year. So unfortunately, we are not allowed to go through the quiz answers. On the GBA side, I hope all of you all saw your GBA results already. It has been posted. So maybe we'll just use a couple of minutes to go through some of the general feedback. I think overall the class did very well. I think most of you all would see that you have scored quite well for the GPA. And one of the reasons why is that actually the school took into consideration the quiz, which was quite difficult. I think that overall across the different classes, most students found the quiz quite difficult. And so on the GBA side, the school has provided some help, and so that overall, for your continuous assessment, you will still fare relatively well. So on the GPA side, I think most of you scored quite well in that aspect. So, are there any specific questions relating to your GPA? You can feel free to unmute yourself if you do have some queries, kind of things that you don't understand based on the feedback that I've written. So as you review your GPA, in terms of like sharing the model answer, I think this is probably not the first module to say this, but we cannot share the model answer. However, we can take questions if you do have specific questions relating to your GPA answers. So, do we have any questions? Um, no questions. Okay, so I think overall most of you all managed to do all the questions. So I just give some general feedback. Um, for question one, so I hope you have your GPA in front of you. So for question one, all of you all could actually get 1A, 1B. So that's relating to your time value of money. So that question I think was very well done. 1C, we had a example in the lecture. So those of and we actually went through like a perpetuity kind of question. So majority of you all could get the answer right. There was a bit of concern about the phrasing of the question, and this relates to the portion where they say dividends are expected to decline 3%. So this one, there's a bit of interpretation. Some of y'all interpreted decline by 3%. Some of y'all interpreted it as decline to 3%. In both cases, they are marked correctly due to the ambiguity of the question. So do not worry for your finals. If the question is ambiguous, um, put your assumptions and then or what you interpret the question to be. Most of the time, if the question is ambiguous, you'll be given the full marks for the alternative answer. Um, Moving on, any questions for question one of the GBA? No, no questions. Okay. Uh, okay. Okay. Question two: are we able to use 5% as a risk rate, or do we have to use 5 to 8%? Okay. Moving on to question two. Um, the risk-free rate is, I think, wait, are you referring to 2B? Yes, okay. So let's look at 2A. 2A, I think almost all groups got it correct. It's kind of maybe some of you make small mistakes, like careless mistakes, but in terms of concept, 2A, I think was very well done. For 2B, okay, this is a bit tricky, right? So the risk-free rate. So the question say market risk premium is 8% and it's 5% above the risk-free rate. So I hope you can see that this phrasing means that the risk-free rate is 3%, right? Because your market risk rate is 8%, which is 5% above the risk-free rate. So 3% is the risk-free rate. So the correct risk-free rate you should use is 3%. Okay. In terms of my marking, I was a bit lenient on this. So if you use the wrong risk-free rate, actually the your conclusions are quite different. So do I hope you be very careful during exam because not all markers will give you error carried forward. So in a sense that if you use the wrong risk-free rate, your decisions might be different, right? However, I do give you the full marks for the group if the decision that you make based on the wrong risk-free rate still makes logical sense, right? So just be very careful for such question in finals, depending on how strict the marker is, they might not give you marks at all for explanation. So this is a 20 marks question. Actually, the explanation is almost, I think it's 12 marks. So depending on the marker for your final exam, you might not get a 12 marks at all. But for me, I just give the full marks if your explanation based on, let's say, the wrong decision you have made makes sense. Okay, for question 2A, I just want to point out a small little um, thing that to take note of. So please refer to your question 2A. So in question 2A, they mentioned that dividend paid last year was 0.5. Um, so on this point, maybe I should pull out the question. Just give me 1 minute. I'll just quickly pull out the question from Canvas. Okay, for question 2A, the final answer should be 8.92%. Okay, question 2A. However, I want to highlight to you something. So question 2A is also a bit ambiguous, right? So there are two actually correct answers. Number one, um, looking at this, right? Can you see this phrase? Dividends paid last year were 0.5, 0.5, right? So some groups did this, right? Because we know last year is D minus 1, right? And we know that we are at the time equal to 0, right? Which is D0. And remember, for a perpetuity question, we always need to use 1 year from today. So today is times 0. So we need to find what is D1, right? So D1 is equals to 0.5 times 1.03 times 1.03, right? Because 0.5 is D minus 1. Everyone understand this? So this is the first correct answer to based on this D1. Now, alternative answer is that D1 equals to 0.5 times 1.03. So why for the alternative answer, you only multiply 1.03 once? Anyone wants to give it a try? Because I know some groups did this, only multiply once. Uh, do you like to, whether unmute yourself or put the group chat on why you only might multiply once? And for this answer, both are correct. So you can multiply once or multiply twice. Okay, that this explanation doesn't make so much sense. If take period one as last year, then multiply once, period zero as last year. But they say current, right? The current share price. If this is the current, this is D naught, right? Current is D naught. So that doesn't make too much sense, right? Because if you say if current is D naught, current price is D naught, unless you say the share price last year is 6.6. But now they say the current, which is D naught, 6.6, dividend last year, which is D minus 1, is 0.5. Anyone would like to one more try? What? So I know quite a few groups actually use this one. Just put this 0.5 times 1.03. Just one time. Okay, maybe it wasn't fully understood, but you just multiply once. So so in your final exam, please read the question very carefully. In this question, you are lucky that both answers, this one and this one, will be given the full marks. But in the final exam, it might not be the case. They might put a trick here, and so this question is actually a little ambiguous. And the reason why is this, right? Paid or unpaid. So what does this mean? It means this, right? If your dividend is last year is 0.5, but if your dividends last year is on unpaid basis, this question doesn't say whether paid or unpaid, but if it's unpaid, what does it mean? It means that the dividend last year was 0.5, but it's not paid yet. And generally, right, how dividend work is that they will declare the dividends last year, and if it's unpaid, means that they only pay you this year, which is D naught. So in this question, it was not mentioned whether it's paid or unpaid, which is why if you treat it as an unpaid scenario, the dividends is declared but unpaid, means what? It means that D1 or D naught, sorry, is 0.5 on unpaid basis. Now, if it's on paid basis, means that dividend has been paid, then you need to use this like that. Okay. So those who are more accounting trained, you know that dividends are generally declared and paid on different dates, right? So sometimes it can be declared on 1 year, paid the next year. Usually that's the case. Yeah. So you're right. This thing, sorry, give me a moment. This thing is paid, but the thing is, uh, um, yeah. So I see that there's a bit of confusion, right? Because of this word paid here. So actually, okay, so in very strict sense, actually, this is the only correct answer. So in a very strict sense, because it's really paid, um, and so it is paid at 0.5 on D minus 1, meaning D naught is 0.5 times 1.3, 1.03, and D1 is um, 0.5 times 1.03 times 1.03, right? Now, then some people can argue, which actually most of you I think only did this, right? 0.5 times 1.03. And one can argue that this version of paid does not mean that the dividend is actually paid. It can be declared and paid or just declared but not paid, right? So in a sense, we were trying to be a bit more lenient to say that okay, we give you a benefit of doubt, meaning that maybe you're referring to this paid as not saying that it's actually declared and paid, but it's just declared, right? So meaning it's not paid yet, it's just declared, which is why we can accept the alternative answer of this, which is I believe what most of you actually wrote. So in this sense, it's a bit on the English side of things, but we were actually trying to be so a bit more lenient in the marking to give most group, I think, the benefit of doubt to say that this answer is also correct. So the question would actually say that is declared and paid last year. Let's say it's declared and paid last year, then there's no ambiguity. It means that it's declared and paid, so only this answer will be correct. So declared and paid last year means that B naught is this year. Yeah. So they will say declared and paid, right? So in this sense, let's see. Okay, why is it multiplied twice? Okay, so because okay, let's treat it as is really paid. Let's just say paid. That in this sense is actually paid. So remember, let's draw the timeline here, right? So the timeline, okay, I'm just going to write over this. So normally we are time zero, right? Which is now. Okay, so this is time minus one, one, two, three, right? So we know that the current stock price of 6.6 is 6.6, right? Is now, correct? But we know that the dividends here is 0.5, which is last 1 year ago, correct? So we are at the point of now, meaning that we need to, and we know that, okay, before that, we know that for perpetuity, we need to find what is the dividends here, right? The question mark here at time minus one. Sorry, time equals to one, right? We need to find what is this. So this answer here means that we need to compound the dividend at d minus one once, two times to this figure here, which is why we use 0.5 times 1.03 times 1.03, so that we can find what's the dividends at this mark, and then we discount it using the perpetuity formula to time equals to 0. Does that make sense? Yes, yeah, you're right. So you're right. So the question say paid can be just declared but not paid. But if the question say declared and paid, then there's no ambiguity, right? Again, I want to highlight that this is more because we wanted to be lenient. Like if we just read it as paid, we don't care about declared and paid and all these things, then the only right answer is this, right? But if you ask like someone who's more accounting trained, they would say, oh, dividends, you can say that's declared but not paid yet, or it can be declared and paid. And so by just saying paid doesn't give you the full detail whether it's declared and paid or is it declared and unpaid. Okay. Any other questions for this? So I hope you understand why you must multiply by two times, because we need to compound it to year one here. Okay. All right, no other questions. Then we move on to last question here. So the last question, right? I think only one group managed to do this, and of course that group got the full marks for question 3A. This question is actually asking you to explain this part here, the non-conventional cash flow. So only one group did realize that this question is about asking how do you explain this non-conventional cash flow? What are some of the issues related to non-conventional cash flow? And so that group, of course, got the full marks. But most of you all did not realize this, and you went on to explain other things. You still got some most of the marks, um, but of course not the full marks. So this in this question we are a bit more lenient because actually most of the groups did not realize the issue is on non-conventional cash flow, and therefore we were a bit more lenient to not deduct actually most of the marks, right? Actually, you're supposed to just get like 5 marks, but you will realize that you actually got quite a fair bit of marks, even though you did not mention non-conventional cash flow and explain the IRR issues, how the profile of the IRR cross and all those things, right? But please take note that of course in a final exam, we usually in final exam they are usually marked stricter. I mean, it's not they won't give like some leniency kind of marks. So please be very careful when you read the question, right? So this question they want you to talk about non-conventional cash flow IRR issues. Any questions on this 3A? They are actually asking you to assess the project, but then they want you to pick up that, oh, it's non-conventional cash flow, so you need to talk about MIRR, right? So you cannot use IRR, you need to say that there's multiple IRR, maybe you can use MIRR, or of course, at the end of the day, maybe you can conclude that, oh, the best method is to MPV, right? Um, and then uh, with the explanation, you probably get the full marks. How do you know it's non-conventional cash flow? Okay, so how do you know is that because the cash flow becomes negative here, right? So whenever, okay, so if you need a recap, I really encourage you to watch the recorded lecture again. But the key determinant of non-conventional cash flow is that when there is a negative cash flow in the subsequent year after year zero. Okay. For question 3B, I think most of you all got the full marks. There are no major issues for 3B. How do you know where is interest? The question is asking about non-conventional. I guess the thing is, once you see something like this, when there is a change in the sign after year zero, you immediately need to know that is there could be an issue of non-conventional cash flow. So even though you use NPV, we know that NPV is always you will always get a correct result, but at the same time, your IRR will give conflicting results, but only in certain discount rate, right? So we need to talk about the different discount rate on where the profile cross, etc. So I guess you need to look at the question and see, oh, okay, because there's a change in the sign of the cash flow, that's why the focus should be on non-conventional cash flow. Yes, yes. So you should point out like, oh, there's a non-conventional cash flow, and because of this, you explain about IRR, how IRR will give multiple results. I think the one group that did very well even plot the graph to show the crossover point. Remember, we discussed about the crossover point in our lecture. So you need to talk about the crossover point. You need to talk about how MPV is always correct, but at whether it's before or after crossover point, you will give conflicting results. Yeah, so you need to talk about all those. Okay, question B, 1B, bond price or call plus increase. Yeah, okay. Is that a question? Bond price with call plus increase in credit rate. Okay, so question 3B, most of you all got the full marks. I think not much issue. Just I think one or two groups forgot to take into account the impact on WACC. So you might have lose a couple of marks here and there because you did not explain about what's the impact on the WACC. Okay, so uh let's see one more question. Can I? Okay, what's the difference between question 3A and 3B? So question 3A is asking you about as this thing, right? Assess the cash flow. So question 3A is asking about you have to explain the non-conventional cash flow, IRR, whatever we talk about, right? So for question 3B, they're actually just asking you to critique this statement here. So let me just erase this thing here so you can see what's the statement. So 3B, right? Sorry, yeah, 3B is asking you to critique this statement here, this written statement, right? So that's the difference. 3A is asking you to analyze the cash flows. Now, 3B is asking you to critique the statement, which is about depreciation and tax. Ah, no, because so please be careful. See, during the board meeting, this board meeting, right? The following statement was presented. So the question 3B is critique the above statement presented to the board meeting. So this is the board meeting statement. Yeah. Yeah, so please be very careful when your exam, especially I understand it's a physical exam. Maybe there's exam stress. Um, yeah, try to calm yourself down, read the question carefully, and answer the question, right? I know it will not be easy for your finals because you know there are not many modules that you do a physical exam, uh, pen and paper, even though you can use Excel. But just try to be in a mood that you are more relaxed and do not be too anxious, okay, for your finals. Having to multiply twice, what are you talking? Which one are you referring to? Um, Sorry, can you elaborate why me having to multiply twice? Okay. So this one is you can refer to lecture lecture two on time value of money. All right, most welcome. Okay, so let's do our last lecture. If we do not have any more questions for the GBA, and okay, so if you do have more questions, we can you can type them in the group chat during our break as well. Then we can just run through some of the your questions. Okay, so let's start today's lecture. So today's lecture, it's on our final topic, a bit lighter compared to the last two lectures. So I know some of you have been saying that it's quite heavy. So the good thing is that our last lecture is slightly lighter. So hopefully that is a positive. Um, and so, okay, let's start. Okay, so today's lecture, we talk about working capital, right? A question for all of you. What is working capital? I always like to ask this question, like, what is working capital? We talk about it in, our primary school days, our first lecture that we were covering financial management, and now we're at the final lecture already. Yes, correct, perfect. That's the answer I wanted to see. So the fund needed for the day-to-day operations. You're totally right. So far we've been talking about things like even the last lecture, we are talking about CapEx, right? Capital expenditure, like big projects, whether we should extend the projects or not. Now, in this lecture, we're finally talking about funds or capital required for day-to-day operations. All right. Um, and so let's look at two options available for the firm. The first option is this. We can pay the supplier during using cash. We hold a lot of inventory and then we give our customer some credit. What does this mean? It means, first of all, we have high funding or working capital requirement. Why? Can you see that if we pay our supplier immediately, and then we give credit to our customer means what? We need more money in our business, right? Because we have to immediately keep on paying our supplier, but at the same time, our customer will pay us much later, right? And so this requires more funds in the business. More funds in the business for daily operations means more working capital, so higher working capital. We have low cash flow and low ROA, return on asset, right? Why lower return on asset? Because we have high working capital requirement, means that there is more asset in our business. So when we calculate return on asset, since our denominator is bigger, our ROA becomes smaller. Now, on the flip side, we can take the option two, where we get a loan credit from the supplier. This is 60 days from credit. So we only pay our supplier 60 days later. Our inventory is just in time. We do not hold a large amount of inventory. And the cash to our customer is on delivery. Means what? It means that when our customer buys something, they have to pay us immediately, right? So in this sense, we are actually paying our suppliers later, but our customers are giving us money immediately. And so this will have low working capital requirement, means that a high cash flow, and because our asset base is small, right? Our asset is small, our ROA becomes big, right? Higher ROA. Now, I have a question. What kind of business would have option two here? What type of business? F&B, you're right. That's right. Supermarket, perfect. Yeah, you're right. Those are good example of option two. Contract manufacturing, yeah, possible as well. Yeah, that's right. So you're right. So those are some of the business, right? So where our ROA is high and you have lower working capital requirements. So just a small recap, working capital is CA minus CL. The main components of our working capital includes things like cash, because these are CA, inventory are CA, receivables are CA, and your CL, which is current liabilities, is your payables. So the goal of working capital management is to ensure sufficient cash flow to meet our short-term operations or day-to-day operations. As we saw earlier, the working capital can affect your ROA, which therefore affects your company's stock price, which is sometimes determined by ROA, return on asset. Okay. So, in a situation of option one, where we saw earlier, which requires high working capital requirement because of low cash, how do we manage this high working capital requirement? We have to get some financing. Financing meaning that we get like a bank to actually help us finance to give us more cash, right? In a situation where there's low working capital requirement, like option two that we saw earlier, like we talked about supermarket, hawker, some of you also met hawker or F&B, then we might have lesser financing requirement because we have more cash that is already in our business. So we do not need to rely on financing from the bank to finance our business. So there are some sources of cash. So some of the sources of cash includes, things like taking on a long-term debt or loan, maybe capital injection, where the shareholders inject more cash, so increase in equity, increase in current liabilities, meaning that short-term debt, so short-term loans, um, decrease in current assets. So this is when we receive money from our customers, so lesser accounts receivable, so receive money, so our current assets decrease. Maybe a decrease in fixed assets. For example, when we sell our fixed assets, we might have a we might have some cash, right? Remember, we talk about things like salvage value. When we sell our fixed assets, we have salvage. So this results in some cash. Users of cash can say to pay off our debt, so decrease in debt, pay off our equity, so we return money to the equity holders, um, or not return money, sorry, a share buyback. So we reduce the equity and give them the cash. It can be also decrease in liabilities, current liabilities, so decrease in short-term loans, or we can have an increase in current assets, so like things like buying inventory, so increase in current assets, or increase in fixed assets, right? Increase in fixed assets means that we buy a machine. Let's say we buy a machine, this will increase our um, fixed assets but decrease cash. So this is a small recap. This is based on lecture one. So lecture one, recall that we talk about a few things, right? We talk about this inventory period and accounts receivable period, right? And we did the calculation as well. Now, if we add up the inventory period and accounts receivable period, this is called the operating cycle here, right? If we add them up together, accounts receivable and inventory period. Now, if we minus away, we take the operating cycle, minus away the accounts payable period, which we have learned how to calculate in lecture one, this will give us our cash cycle. So So maybe your question is, what does this mean? What's the operating cycle mean? What does the cash cycle mean? So let's try to put this in context, right? Okay, operating cycle. So operating cycle is we take the inventory period plus the accounts receivable period, and this gives us the meaning of the time between when the firm purchase the inventory and receive the cash back from selling its products, right? Purchase inventory, inventory period. Receive cash back from selling its products. This is your accounts receivable period. So I have uh, put a recap here for lecture 1C on how we calculate our accounts receivable period and inventory period, right? So I'll not go through this again. If you need a recap, feel free to watch lecture 1. But there's one thing I want to highlight to you is that we need to use average. Always use average AR, right? And so we'll have a couple of questions in the following slides to show you why. So we have this example here. Average cost of orange per month is 1,000. Total cost material in a year is 12K. Number of orders per year is 12. So the inventory turnover, we take the cost of goods sold, which is the total cost of the material, divided by average inventory, which is 1,000 gives you 12. Okay. After that, we take the inventory turnover, or we take 365 divided by the inventory turnover, and this gives you 30.4 days. So it takes approximately 1 month. So it takes approximately 1 month for the firm to purchase the inventory and finally receive the cash after selling its product. Right? It takes 1 month, 30.4 days. So to calculate the the receivable period, we can first take the credit sales. Again, I want to highlight the small little thing that I probably talk about in lecture 1 as well, is that we only consider credit sales. This is very important because only credit sales will lead to accounts receivable, right? So in the exam, sometimes exam can be very tricky. They give you cash sales and credit sales separated and ask you to calculate receivable turnover. Please only use credit sales. So once you select your credit sales, take credit sales divided by your average accounts receivable. So again, this average is important. I put a star here. And this will give you your receivable turnover. Thereafter, we can take 365 divided by receivable turnover to give you the number of receivable period, number of days. Now, when you add them up together, right, inventory and account receivable period, we get a 48.7 days. And usually the last part of any exam question or any assessment question is ask you, what does this mean? What does the operating cycle of 48.7 days mean? So you need to explain that this means it took the company for 48.7 days to receive the inventory, sell it, and collect the receivables generated from the sales of inventory, right? So it takes 48.7 days. So it's almost a month and a half for them to do receive inventory, sell, and collect the money. No. So you can leave it at 1 decimal point. That's fine.
Hey, Prof. I have a question. So in the previous question, right, it says it takes about 1 month to purchase inventory and get cash from selling. How is this different from receiving accounts receivable?
Sorry. Actually, you're right. So this 1 month, right? I'm talking about this 1 month.
Uh, yeah.
Yeah. So this is actually the That's a good point. Thanks for pointing it out. This is actually the inventory period. So inventory period is actually how fast they actually sell the inventory. So it takes 1 month for them to sell off the inventory. Yeah, right. So it's not about the collecting of money. Now, then the receivable turnover, that's about collecting the money, and the operating cycle is the inventory period plus the accounts receivable period, means that it takes 48.7 days for them to receive inventory, sell it, and collect the money. Yeah. So thanks for pointing it out. Yeah. I mentioned a bit wrong that last point on the 1 month. Does that make sense for you?
Yep. Thank you.
All right. Most welcome. Thanks for pointing it out. Okay, so we have a company here with weekly credit sales of 33,4,500. The average collection period is 37 days. What is the average account receivable figure? So we know that the weekly credit sales is this amount here. So the daily credit sales, we take this divided by 7, right? As you can see here, to give you the daily sales. So if you know that they sell this amount per day, 4,928 per day, what is the accounts receivable? So because it collects on average 37 days, we simply take the daily sales multiplied by 37 days to give us what is the average account receivable that we have. Okay, so moving on to the cash cycle now. So just now we talked about operating cycle, right? Then I mentioned the cash cycle is operating cycle minus the accounts payable period. And recall in lecture 1, we have talked about accounts payable period. This is the cost of goods sold divided by average accounts payable. Thereafter, take 365 divided by the payable turnover. Okay, so what does this mean? What does a cash cycle mean? So a cash cycle is the time between the payment of inventory and the receipt from the sales of inventory, right? So remember that at the end of the day, we have to pay for our inventory, right? To our supplier, we pay them back the money. The question is, how fast does our customer give us the money, right? So the time difference between our customer giving us the money for the sales and us paying our supplier is the cash cycle. So cash cycle measures how long we need to finance the inventory and receivables, right? So think about it, right? In terms of accounts payable, do you prefer it to be longer or shorter? Accounts payable period. Do you want it to be longer or shorter? And why? Longer. Okay. Now we have mix of longer and shorter. Okay, most of you say longer. You're right. So those that say longer, you're right. Why? Is because it means that you pay us, you let's say you're the company, you will pay the company, you pay the supplier later, right? So you can hold the cash within your in your balance sheet. Yes, you have more time to pay your supplier. So longer is better. On the accounts receivable side, we want it to be longer or shorter? Shorter, right? This one is a bit easy, right? Accounts receivable, you want to get your money faster, right? Yeah, get your money ASAP. So by using operating cycle, we consider accounts receivable and inventory, and then we minus away the account payable. So we are actually determining how long does it take for the payment of inventory and the receipt of money from the sales of inventory. So we really look at how long does the cash take to, pay inventory and then subsequently receive the cash back, right? So we are looking at the cash cycle here. Okay, so we have a question here. Now we're given this. So this question is very nice. They give you a beginning, ending, and average. So This is quite typical. Generally, when such question comes out like this, they are testing you whether you kind of understand that you must use average. So please do not use ending or beginning. You must always use average for your calculation of days payable, uh, inventory days payable, inventory payable, uh, payable days, and your accounts receivable days. Okay, always use average. So the question is how calculate operating cycle. So we have our inventory turnover. So we have the cost of goods sold. So the cost of goods sold divided by average inventory. You can add the beginning plus the ending, or you can just use the average inventory as given in the question. Calculate what is the inventory turnover here. Take 365 divided by inventory turnover. This is number of days for inventory period. We do the same for receivables. Uh, Taking note that we must use the credit sales here, credit sales. And we calculate the receivable period as this. And so we can find what is the operating cycle. We just add both the inventory period and receivable period. So it gives us 168, means that it took 168 days to receive the receivable, sell it, and collect the receivable to generated from the sales of the inventory. The question, however, also wanted a cash cycle. So we can calculate our payable period as given here, right? Then remember for cash cycle, you need to minus. So we minus 39 days. So it means that it take um, the inventory and receivable must be financed for 129 days. Or we can say that the firm received cash on average 129 days after paying suppliers. So there are multiple ways of trying to explain what does the cash cycle mean, what does the operating cycle mean, right? But in essence, it means that there is, of course, in the cash cycle sense, there's a 1 to 9 days difference in terms of the timing. Always, are you saying, okay, so I see a direct message to me. The question is, the cash cycle is always 1 year. So no, it can be 2 years, can be 3 years as well. Um, it depends on the turnover, right? So think about it. If the turnover, let's say the turnover is 0.5, right? Let's say the turnover, right? Let's say this is 0.5. Then if we take 365 divided by 0.5, so this will give us more than 1 year, right? More than 1 year. So it can be more than 1 year. So it really depends on what's your turnover like. Does that make sense? So depending on the industry you're in, some turnovers can be quite long. Yeah. So whether is it payable period, accounts receivable period, or inventory period, those period can be more than a year depending on their turnover, right? So in this case, their turnover, of course, is more than one. So this turnover is more than one. So it's less than a year. But imagine if you have 365 divided by, let's say, 0.1, and 0.1 is the turnover, then the value here will be more than 1 year. I'll not go through this question because this is just another repeat of the same method. So please go through this on your own. I just want to highlight to you this part. Can a firm have negative cash cycle? And the answer is yes. means that when it sells, it collects cash faster than paying its creditors or suppliers, right? So in this sense, if you have this a restaurant business or in or just in time production, this usually has a negative cash cycle because you receive things in cash, like from your customer, you receive the money in cash. However, you pay your suppliers on credit. Okay. Let's talk a little about this thing called short-term financial policy, right? So basically, the idea of short-term financial policy is about liquidity of the company, right? So can the company manage its liquidity requirements when it needs to? And some of the most common liquidity products includes the simplest form is cash, short-term funds like trade credits, maybe bank limits. Um, and this will help in terms of managing the liquidity of the company or the cash flow of the company, right? So these are a primary source of liquidity, cash, short-term funds. Our secondary source of financing includes things like liquidating of asset, filing for bankruptcy, negotiating debt contracts. So all these are no, not so positive because they are secondary sources, means that you actually sell the company, sell the asset away. So these are like negative sources of liquidity, which we want to avoid. Okay, so this a lot of words, but let me try to explain to you what's explained here. So the amount of short-term financial policies required would largely depend on a number of factors, right? So the thing about it is that the size of the firm's investment in current assets will actually determine how much short-term financing is required. So this measures the relative firm level. So this, in terms of the firm size, is measured relative to the revenue of the firm. So another factor affecting whether short-term financing is required is also on the how the current assets being financed, whether are they being used on based on short-term debt or do you use long-term debt to finance your asset? So as we think about it, long-term debt usually is more expensive, more interest, um, and so we need to continuously pay the interest, right? So we need more cash to ensure that interest are being paid. On the other side, short-term financing, um, is shorter, but there's potential risk of whether we can get a refinancing of the short-term debt. So what does this refinancing mean? So in simple words, in layman terms, it's like, I let's say you get a loan from the bank, right? You get a loan for 1 year. Now, next year, if you want to get a new loan from the bank, there is a risk that the bank will not want to loan you money anymore, right? So this risk that whether a bank will loan you money next year is called refinancing risk. And so short-term debt, they might be better, but there's a high level of refinancing risk involved. Of course, there is some flexibility whenever you have more short term compared to long term, right? So based on this, we can come up with two um, separate policies, right? The first policy we have here is a flexible policy, and this flexible policy means what? We have large amount of cash in our balance sheet, large amount of securities, large amount of inventory, and this means that we have large amount of accounts receivable as well because we give a lot of credits to our customers. This would mean that we require a high level of liquidity because we are giving so much credit to our customer, right? So relatively high liquidity is required. On the other extreme end is more on a restrictive policy. A restrictive policy means that we have low amount of cash in our balance sheet, low amount of inventory, and then because of this, we are very stingy. We don't want to give our customer um, account receivable, or we don't want to sell them on credit, right? And so the liquidity is less. And I hope you can see immediately that there are distinct cost benefit involved in our flexible and restrictive policy, right? And we'll talk about this in a bit in this slide. But let's see what this means. It means what in a flexible policy, we are going to get a long-term financing for this amount of so-called assets. And on a yearly basis, there are some fluctuations in demand. And so what we are doing is that we are going to use the long-term loans that we get to meet the fluctuating demand. So we use long-term loans to meet the fluctuating demand. And this might not be good. Anyone can kind of understand why, or can maybe put in a group chat or unmute yourself. Why is it not so good to have use long-term financing for uh, yearly kind of fluctuations like this in a flexible policy? And you like give a try. Why is it not good to do this? Interest, you're right. You might lose value on the value of the money. Okay, I think I understand where you're coming from. So interest, you're right, because long-term financing generally is more expensive. So if you're going to use long-term financing for this kind of yearly fluctuation, you're actually going to pay a lot of money, right? Do you, like for example, when the demand is here, do you actually need so much like buffer? Maybe not, yeah. So you're putting a lot of money there, and if you set the money aside, I think I can't understand what you're trying to say. You lose the value of the money, right? So you are right. Um, and one of the main things, the interest of long-term financing is higher. Now, so the flexible policy might not be too good, but at the same time, flexible policy might be good because let's say if there's a spike in demand, let's say suddenly, right, from here, the demand just shoot up all the way, right, to this part here. So you do still have some buffer, which allows you to meet the demand when there's a sudden increase. So it might be quite good as well. Yes, like COVID mask. So like companies that stockpile on COVID mask could actually sell it for quite expensive when there was a spike in demand. Yeah, right. So on the restrictive end, this means that you only meet your bare minimum. So you use long-term financing for the bare minimum of your demand, and you use short-term financing to finance your difference here, the spike in demand. And so this is generally a preferred kind of policy because short-term financing uh, is the reverse of long-term, meaning that the interest rise is a lot cheaper, so it's better for your for 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 in terms of interest wise, right? So there are some uh advantages and disadvantages of the flexible policy. Advantage, you have no difficulties meeting the short-term requirement obligations. You have excess amount of money for emergency as well. Okay. The disadvantage is that I think like what some of you all say that the liquidity or like a large amount of let's say cash that is being placed there has low return, so you are like losing in terms of the losing the value of the money. I think that's what you're trying to say. You have low returns. At the same time, flexible policy might mean that you need to have more asset, more inventory in the asset, and this will result in storage cost. Last but not least, the difference in the tenor, like what we talked about, will result in different interest amount that you have to pay. Of course, long-term debt is a bit more risky as well, so different risk level. Okay, so I think I saw a question. Isn't long-term financing usually lower than short-term financing? So no. Okay, so this question is very good. It's a yes and a no. Okay, let me try to explain to you why, right? So for those who are interested in finance or on the finance track on your degree, with SUSS, you will learn about this in a lot more detail in the more advanced modules. But let me try to explain to you, maybe in more simple terms, right? So when you compare credit card loan and home loan, first of all, we cannot compare it like this because the quantum or the money, the amount of loan you're taking is very different. So based on the amount you're taking, the interest rate is different as well, right? So you cannot compare it like this. But let's think about it generally, right? Generally, when you put money in a deposit, let's say, okay, let's think about deposit. Generally, if you put money in a bank, in a deposit account, think about it. If you put the money for 1 year versus I put the money in the bank for 5 years, which one do you expect to receive more interest at the end of the maturity? 1 year or 5 years? Yeah, 5 years, right? So this sense, this is very clear, right? So a bank loan to you is the reverse. So imagine the bank is going to loan you money for 1 year versus loan you money for 5 years. So the 5 years one, naturally you expect to pay more interest. So this is in a general situation, right? It will be like this. However, for those of you who are interested in finance, you will have noticed that the current situation in the market now is that the long-term financing is cheaper than the short-term financing. And this is due to the various market conditions. We can go into detail, but I don't want to, overwhelm those that are uh, maybe do not really follow too much of the finance news. But the idea is that okay, so it's general knowledge. General knowledge is that the yield curve. So you don't need. So those that don't want to listen about this can just take a small break. But those that want to listen, you can kind of try to understand. But the idea is that the yield curve gives the different rates is now inverted. So when there's an inversion of the yield curve in the market, what happens is that the long-term rate becomes uh, lesser than the short-term rate. What does this mean? It means that if you put your money for 6 months in the bank, it gives you more interest than you put the money in for 5 years. And this is a very unusual situation, but it's the current market situation now. In the most common situation is that the long-term rate will give you more than the short-term rate. Okay, so if you are interested to find out more, you can Google yield curve inversion on Google, and you'll find out a lot of explanation of why it's inverted. But this is beyond our course. Maybe I'll cover one last slide before we take a break. As usual, we want to have two breaks. So the next part is there's some advantages and disadvantages of restrictive policy. Basically, it's the kind of opposite. So some advantages is that higher returns on long-term asset because our long-term asset is just covering the bare minimum, means that you have higher returns. Um, Lower carrying cost as well. You do not need so much inventory. It's cheaper. Short-term liabilities can decrease more easily during economic downturn. Means what? It means that because we are using the short-term financing just for the spike in demand, if there's no spike in demand, we just don't use the short-term financing. That's all. Right? So it's easy in case of an economic downturn. Some disadvantage, there's less liquidity for emergency, right? So one of you give an example on the COVID mask. Imagine sometimes there's sudden spike in demand for COVID mask. If your policy is so restrictive, of course, you have not enough liquidity to meet the sudden demand or emergency. Okay, so let's take a short break here, and then we'll come back maybe in around 6 to 7 minutes time. Okay, so around 8:20, and then we'll continue on the lecture. If you do have any questions, put them in a group chat. All right, let's take a short tea and coffee break. All right. Welcome back. I hope you have a quick short break. Okay, so let's move on slightly to try to understand what is the best financing policy, right? So the best financing policy, there's unfortunately, no definitive answer. However, there are some important things that we think about, right? So this slide has a lot of expert kind of like elaboration, but let's try to just understand the broad idea, right? And then you can look at the slide in terms of more detail. So the idea is, first of all, right, is that we need to consider how much cash do we want first, right? How much cash do we want um, in our business, right? We know the restrictive policy has very little cash. The more flexible policy has more cash. So in terms of forecasting our demand, if we know that there is an increase in demand in the coming years, then we want to ensure that we have enough cash reserve. Okay. The second thing is hedging of maturity hedging. And what does this mean? It's the idea that when we compare the loans that we take, right? We want to make sure that there is no mismatch between the maturity or the duration of the loan versus the asset that we're trying to finance. What does this mean? It means what? It means that let's say we're trying to finance working capital, which are the day-to-day operations. We want to avoid using long-term loans, which have a long maturity, to finance working capital, which is a daily thing, right? Daily operations. So we want to avoid this. So we want to ensure maturity is being hedged. That's what we're trying to say, right? Last but not least, the relative interest rate. So generally, like what we earlier mentioned, short-term rates are lower than long-term rates. And again, I want to highlight is generally, of course, if you're very interested, we know and you want to find out more, look at the inversion of yield curve that we talked about earlier. In the current market situation, the short-term rates are actually ex, more expensive than the long-term rate. So there's a reverse that's happening here. Okay, but then if you're interested, you can look at can Google and find out more. But generally, that's not the case. Generally, short-term rates are cheaper compared to long-term rates. Okay, so the idea is that at the end of the day, maybe what's the best method is let's have a compromise policy. Meaning what? The compromise policy will be something around here where certain portions will still be financed by short term, but at the same time, we will have a bit more long term securities to meet the seasonal fluctuation. So instead of um, having everything as short term financing or everything as long term financing, let's do a middle ground here, which is a compromise policy. Um, so some example of short-term borrowings, they include things like your unsecured loans. And these are very common. So if you're interested in banking, which is where I'm actually working at in a banking sector, do not hesitate to reach out to me, if it's something you're interested in pursuing in the future. And for me, I do a lot of corporate banking. And so this is actually the products that we actually sell most of the time, which is short-term borrowings, things like unsecured loans, letter of credit, committed or uncommitted. Committed means that the bank will for sure have to pay if the client wants the loan. Uncommitted means that the bank can say, I don't want to pay, because it's uncommitted, right? Of course, the interest that you have to pay for a committed loan is more expensive than the uncommitted loan, right? So we have things like letter of credit, which are relating to trade, right? Trade products. We have things like commercial paper and trade credits, right? So or we have things like revolving credit means that the credit can keep on revolving. So for example, if you let's say you have a loan for 10 million. If you pay off the 10 million loan, your 10 million will be available for you again, right? So keep on revolving. Okay, so that's a revolving credit kind of facility. Or these are unsecured because there is no collateral. So simple term for collateral is like there is nothing that is backing up the facility, right? So no collateral. on the flip side, we have things like a secured loan. So secured loan is generally secured by certain assets, certain financing, factoring, um, assignment of certain kind of things like accounts receivable, and so all these kind of collateral would secure the loan, giving um, claim, allowing the bank to claim on all these assets. So you can things like inventory can be used to be secure. Uh, Cash budgeting. So so this is the next portion of today's kind of lecture where we look at cash budgeting. So the idea is that because working capital is used for day-to-day operations, right? The question is, can we actually budget for the amount of cash coming in and the amount of cash coming out so that we know how much working capital financing is required? So this is a classic example to illustrate to you what is this cash budgeting. So suppose we have sales that is given here for first 4 quarters. The beginning accounts receivable is 120. For collection, we have a beginning receivable plus half of the sales. So the beginning receivable and half of the sales will be collected. Means that we're going to get cash coming in. Now, the accounts payable on the other side is 60% of the sales. We do have some expenses, which is 20% of the sales. We do have some interest and dividend payment, which is 20 million per quarter. Important thing is that there's an expansion project in the second quarter, which is 100 million. Last but not least, our beginning balance is 20 million. However, we need to ensure that we always have 10 million available in cash. Okay, so let's try and understand what's happening here. So remember, we start off with our beginning accounts receivable, right? Given the question 120, we make a sales. So the sales is given by 200 as per in the question. So then the thing is, how much cash is being collected, right? Remember, cash being collected is the beginning accounts receivable plus half of the sales, right? So beginning receivables 120 plus half sales. This is the amount that is collected. And at the end of the day, if half of the receivable is collected, the other half of the receivable will be remaining, right? Which is 50% of the sales that remains as accounts receivable. Now, this remaining account receivable at the end will become the beginning of the next quarter. And at the same time, again, we make a sales as per the question, which is 300. We have another cash collection, which is the beginning accounts receivable, 100 plus 50% of the sales, which is 150. Okay, and then we get the ending, which is 150, which is 50% of the sales. So we keep on repeating this, and we get basically this component here, right, which is called cash collection. So cash that is being collected. Now, on the cash disbursement side, let's have a look, see what's happening here. We have accounts receivable, which is 60% of the sales in the first quarter. At the same time, we know that there are some wages and taxes and other expenses, which is 20% of the sales, which we have calculated here at $40. For the first quarter, there is no capital expenditure, so it's zero. And then we know that every quarter we have a 20 of interest that we have to pay, right? So at the end of the day, for the first quarter, we have to make a cash disbursement of this, right? A summation of 120 plus 40 plus 220, right? So you get 180. Now, this is the amount of cash disbursed. We do second quarter, we do the same thing, taking note that there will be a capital expenditure of 100 in the second quarter as well. Okay, so having completed this, we can determine all the cash disbursement, right? So these two boxes that I have drawn or highlighted are the key figures that we want to calculate in terms of our financing. So let's transfer these figures in a separate table, as you can see here. So now we have transferred the cash collection and cash disbursement as you can see here. And let's sum it up together, right? So cash collection is positive, cash disbursement of course is negative. So 120 minus 180 gives you a positive cash flow. Um, and then we keep on doing, right? This is negative cash flow, positive, negative. Now, we are also given a question that there are some beginning cash balance here. So having completed this negative and positive, we input this in a net cash flow here. Can you see here? Okay, so with the net cash flow, we can determine what is the ending balance of cash, right? So the ending balance of cash, I'm just going to change my color, is just 20 plus 40 equals to 60. And we know that the minimum requirement is 10. So we have a surplus of 50, right? Because 60 minus 10 is 50. Now this 60 is going to become the beginning balance in the second quarter. But in the second quarter, we do have a net cash outflow of 110. When there's an outflow of 110, means that when you take 60 minus 110, this gives us a deficit of 50. And this 50, because we still need to have a 10 minimum cash balance, this gives us a further deficit of 60 that we need to top up. And this 60 becomes the amount of money that this company will have to ensure that it's being covered by external financing, such as bank loans, short-term bank loans. And so at the beginning of the third quarter, which is the amount that's being transferred here, Fund Toys will have a cash deficit that must be covered by some kind of financing um, in order to meet its minimum balance requirement. So I'll just pause for a short while here. I think this example is relatively easy, but you just need to be very careful when you transfer figures here and there. So I'll just pause for a short while here. Any questions regarding this example? So this is an important example to try and understand how do we determine, what is the cash that is required that has to be financed using various financing facilities.
Hey, Prof. Sorry, can you go back to the previous slide? So on the capital expenditure, right?
Yes.
In Q2, there is 100. Where does the 100 come from?
Sorry, your question is?
The capital expenditure in Q2 under cash disbursement, where did that come from?
Okay. So then it's here. The major expansion in the second quarter of 100 million.
Oh, okay.
Yeah.
Okay.
So
Thank
you
you.
have to pay 100 million in the second quarter. So it's a one-time off payment in the second quarter that has to be made for capital expenditure. So it's just that's why you only see it one time here. That's all. Mm. There's a good question. Any other questions? I think we don't. Okay. So that's all we have for this first part of the lecture. If we don't have any questions, let's move on to the second part. So, some self-review question we encourage you to look through. So our second part of today's lecture, we're going to cover some key issues relating to granting certain credits. So in the exam, potentially they can ask you they give you an example like fund toys and ask you to calculate, how much funding is required, like what is being shown. Yeah. Potentially they can ask you to do that. Hopefully you realize it's not very difficult. You just need to be very careful whenever you do the tables and then the figures, the ending become the beginning, ending become beginning. And again, I want to highlight to you that in your GBA, generally, it has been quite nice in terms or a bit more lenient in terms of marking by giving you error carry forward. But I want you to be very careful that this might not be the case for your finals, because your final exam, first of all, usually the scripts are being randomized. So I will not be marking, of course, all of your paper. We'll all be randomly marking different tutorial class. And depending on how strict the marker is, sometimes they be quite strict, so they not give you error carry forward. And whenever you have questions that like what happened in fun toys, where the big ending becomes the beginning, ending becomes the beginning. In case you make a mistake at the start, you might at the end say, oh, the financing or not financing, you require a facility in Q3 instead of actually Q4, right? So because of your calculation is wrong, markers can be quite strict sometimes. They do not even give you error carry forward, right? So please do not rely on error carry forward. Just be very careful during your exam. Okay. All right. So, So going into this part of the lecture, um, granting. So there are some a bit of tension, right? The idea is that when you grant credit meaning that you give your customer like a time to pay, increases sales for you. But of course, the cost of granting credit is that maybe the customer might not do too well and they might not be able to pay you, right? Or there's some financing that's required for your receivables, as we talked about it earlier. Remember when we did a fun toys, there might be some deficit and then we require some financing, and this adds on to additional costs to us, right? So we need to ensure that the trade-off between increase of sales and the cost of granting credits is being balanced. That's why we have credit management. And so there's this thing which is quite um, commonly used in the market, which is called term of sales, right? Term of sales, meaning that when you have a sales, they give you certain credit period, or you have to pay off in 60 days, in 30 days. And then they give you certain cash discount if you pay within even a shorter time, right? We'll look at an example in just a bit. Um, and sometimes there's use of certain credit instruments. We have talked about credit analysis in lecture one. So basic credit analysis helps you to determine which client is a good customer, which customer is a bad customer, right? And then in lecture one, we did a quite detailed analysis on how do we do credit analysis. So I'll not really go through that. Last but not least, there might be some efforts expended in collecting receivables. Let's say if you cannot collect the money, you have to use like a lawyer, you go to the court, and all those cost money, right? So they might not be so good as well for you. Okay, so let's look at this thing called term of sales. So this question I want to highlight to you is very standard. So if you see past year paper, sometimes they come out with this question and it's very standard. So please be very competent in doing this kind of question. And hopefully, when you see this question, you can do it quickly, right? So I really encourage you to do it a few times on your own because it's very standard. It's just very mechanical, right? But at the same time, if you don't really understand it, it's very easy to make mistakes. So I really encourage you to do this a few times. So let's look at this basic form of credit sales. So imagine we have something this called 2/10 net 45. So what does this mean? It means that if you pay within 10 days, you're going to get 2% discount. The total amount due in 45 days, the total amount will be due in 45 days, and you'll not get any discount. You pay in 45 days, right? But you have to pay in 45 days. Okay, that's the maximum you can pay. But if you pay in 10 days, they're going to give you 2% discount. So we assume a 365 number of days in the year. Let's say we buy 500 worth of merchandise. Okay, so if you pay within 10 days, how much do you have to pay? You pay 2% less, means that you pay 490. So you pay 2% less. If you cannot pay within 10 days, you pay within 45 days, you pay 500. So you pay $10 more. So effectively, what this means is that you're going to pay $10 interest over the 35 days if you cannot pay within the 10 days, which is actually quite a lot, $10 over 35 days. So moving on to the next part, let's calculate the implied interest if you have to pay $10 within the 35 days, right? Because you cannot pay within the first 10 days. So we have already determined $10 on is the interest amount, which is a 2% on the 500 loan that you have taken. So in terms, okay, so this is going back to your lecture 2 again. So we have this thing called period rate. I hope you all can remember what's period rate. So the period rate basically is the amount of interest that you have to pay divided by what is the so-called the principal amount, which is 490, right? Because you have to pay 490 um, if you can pay within 10 days, right? And so the period rate that you have obtained is 2.0408. And recall that the nominal rate equals to periodic rate or period rate times number of period. And so we know that 2.0408 is for the 35 days. And so in order to calculate the nominal rate or the APR, we fall back on the what we have learned in lecture 2A, where we take the period rate multiplied by the number of periods per year, right? So it's 365 divided by 35, right? Because there are 35 days for that period rate of 2.0408. And so we get the APR of 21.28. Okay. So, like I mentioned, this calculation for APR was covered in lecture 2. So in case you are a bit unsure, you can't really remember what's the APR anymore, I encourage you to look through lecture 2 again. Good thing it's recorded. So please look through it again to refresh what's your understanding of APR, what's your understanding of periodic rate or period rate. Okay. So once we have calculated your APR or nominal rate, we can calculate what's effectively, right? What is the interest rate we get? So we can calculate the effective annual rate or the EAR. And again, we fall back on the formula learned that we have learned in lecture 2A, where we simply take the nominal divided by number of periods, multiply by M, right? The number of periods. And so we just take this 1 plus 2.0408. And so 0408, we know that nominal divided by number of period, this gives us our period rate, right? So we simply take the periodic rate or the period rate which we have found here, right? This is the period rate. Okay. 1 plus period rate to the power of the number of periods here, minus 1. And this gives us the effective annual rate. And it means that if you annualize the rate, if you're going to forego this 2% of trade discount by not paying within the 10 days, we are actually foregoing a 23.5% of discount, which is actually quite significant. I'll pause here. Any question? This question is very important because it's a very standard way of asking this kind of trade discount questions. So, do we have any queries, any doubts? Okay, I guess we are good. Okay, so let's look at an example here. Okay, suppose in order to speed up collection, you have offered a customer a credit term of 1 slash 15 net 60. What is the implied interest on your firm that your customer, if your customer chooses to take advantage of this early payment, assuming 365 days? This is a very important part. If your cost of capital is 9%, should you take this trade discount? Okay, so let's do this very mechanical question again. So I'm just going to zoom in here. You have your question in front of you. So let's look at this. All right. remember, let's just let x, so let x be the amount of money spent, right? Spends a t, because it's the past tense. Okay. So we know that we're going to spend X amount of money, right? So in terms of interest, we are going to pay 1% if we pay in 15 days. So how much interest are we going to get? So the interest is 0.01x, right? Because 1% if we can pay in 15 days, correct? So what's the period rate? So I'm going to, you can see it's very standard. I'm using the same method of doing it. Means what? We're going to pay, we get 0.01x, which is the interest amount, divided by x minus 0.01x. Remember, the interest amount divided by the amount that you have to pay if you take this trade discount. This gives you 0.01 divided by 0.99, which gives you 1.01%. Now, having calculated your period rate, we can easily calculate your APR. Our APR is your 1.01 multiplied by 365 divided by 60 minus 15, right? Basically, you can pay 60 days minus away the 60. So this gives us our APR of 8.19%. Okay, I'm just going to zoom up a bit. Okay, now with the APR, we can calculate what is our effective annual rate. So effective annual rate is given by 1 plus 8.1. No, let's just use the period rate straight away. So we don't need to divide by the APR again. There's 1 plus 1.01% to the power of 365 divided by 60 minus 15 minus 1, right? Our annual effective rate. And this gives us 8.49%. So this is our effective annual rate. So, okay, so maybe just copying this working. So I hope you can notice that this entire step here that I've just done for this practice question is exactly the same. I'm just going to flip back. Don't worry, I'll flip back to the for you to refer to that question. It's exactly the same as the steps that we have done here. Right? We calculate the APR, we calculated the effective annual rate to calculate to get 23.5. Now, the question is, for this practice example, they have given one more question. If the cost of capital is 9%, should you take this discount? So, question to all of you: should you take this discount if the cost of capital is 9%? Okay, no. Okay, why? So this is a very typical question. Yes, no. Okay, so why? Why yes, why no? Okay, okay, I see. You're right. So thanks for the explanation. If discount is higher than the cost of capital, then should take. You're right. Okay, think about it. So I hope everyone can see there's a correct answer, right? So if your discount that you're getting is more than your cost of capital, then you take it, right? So imagine, right? If your, let's say your discount is 8.5%, like let's say the effective annual rate is 8.5%. Now your cost of capital is 9%. It means actually your capital costs more money than the discount. So in this sense, 9% versus 8.5%, you should not take the discount. So you should only take the discount when it's higher than the cost of capital. So only take the discount when it's higher than the cost of capital. Everyone understand? Any questions on this? Yeah, why not take? Okay, let's think about it. Let's say you have a lump sum of money, right? Your this sum of money, so remember, cost of capital is the same thing as how much money you can get, how much so-called interest you can get on your money, right? Interest you can get on your money. So let's say you have a sum of money called X, or let's make it simple, $100. Now, if your $100 can earn you 9% versus your this $100 where you get 8%, 8.5%, which one is better? The 9% is better, right? So imagine this $100, you can actually earn 9% if you put it in a bank. Let's say put in a bank can earn 9%. Instead of paying off your credit, which gives you 8.5%, isn't it better to save this $100, put in a bank at 9%, get the additional 0.5% discount money from the bank, and then you have additional money compared to paying off your your um your credit terms early. Yeah, I hope you can see, right? So if you take this money, put in the bank, get 9%, it's better than just paying off quickly. But by paying off quickly, you only get an 8.5% return. So 9% is better. So you only take your trade discount when your cost of capital is less than your discount, or in other words, your discount is more than your cost of capital. You only take the discount when it's more than your cost of capital. Okay. Okay, so now we look at credit, right? We look at credit policy. So whenever we take on more credit policy, meaning what? What's credit policy? Meaning that we're taking on more like loans, we are taking on more facilities from the banks. So when we take on more and more credit, right? First of all, our carrying cost increase. So what's carrying cost? Carrying cost is the cost that is incurred by taking on credit, and this largely relates to carrying cost relates to interest, right? So the more credit we take, the more interest we have to pay, right? So carrying cost increase. Now, if we take on more credit, the opportunity cost decrease. The opportunity cost is basically the loss of sales by refusing credit, right? So by having more credit, we have two things. First, we have the opportunity cost which will decrease, but at the same time, giving more credit will have more debts, more interest, more possible more losses, right? So the cost increase as well. So when the opportunity cost of taking credit is equals to the carrying cost, which is where the two lines cut, this becomes the optimal level of credit that you should both take. So this will give you the optimal credit policy where your carrying cost equals to your opportunity cost. Okay. Now, in terms of credit analysis, I will not be going through this. We have went into quite detail in lecture one. So there's a standard thing is the 5 C's of credit, which mentioned here. You can have a look at it, what they are. Just read through. Just kind of understand what they are. Okay. Now, in terms of collection policy, first of all, we need to monitor the accounts receivable, right? So I believe in accounting, you have also probably have seen this before. It's called accounts receivable aging schedule. The aging schedule gives you how the accounts receivable are being aged. Meaning how much of them are past due by how many days, how much of them are not past due. So generally, they kind of provides idea of how much payment is being overdue, right? So this monitoring the accounts receivable. Now we do have some collection policies. Generally, if we reach the collection policy stage, it means that maybe you can't get back money, right? There's quite a bit of chance you can't get back money anymore. So this is where you have things like a delinquency letter, phone call, collection agency, and some legal actions taken. Okay. Now, moving along on the inventory management side of things, we know that there's cost involved in inventory, right? When we think about just-in-time inventory, so just-in-time inventory means that you are going to manufacture inventory as and when your customer needs the inventory, right? So when we think about just-in-time inventory, we carry less inventory, means less cost, right? On the flip side, if you carry more inventory, there is more cost involved. Because there's cost involved in carrying too much inventory, as well as there's cost involved in carrying not enough inventory, right? So there's going to be a balance again, like a balancing beam, right? So we must find what's the optimal level of inventory where there is not too much inventory and not too little inventory. So then various types of the inventory, we have raw material, finished goods, and work in progress inventory. So finished goods ready to be shipped, work in progress inventory is still being manufactured, and raw materials is it's still like in its raw stage, right? So unfinished. So inventory cost generally 20 to 40% of the inventory cost per year. They include things like storage, insurance, loss due to obsolescence, theft, some opportunity cost in terms of the cost of capital. So this means that let's say you spend a lot on buying inventory. It's good they have more inventory, but at the same time, it means that this amount of money actually you can use it to spend on other things, right? Maybe people go some make investments which might be more profitable than just um, uh, using it to buy inventory. In terms of the storage costs, storage there's some shortage cost as well. So shortage cost means that because you're not enough inventory, you have to buy more inventory. And whenever you buy inventory, there's cost relating to restocking the inventory, right? There's some restocking costs involved. At the same time, there's some loss of sales uh, from the customer if they cannot get the inventory in time. So very similar to our credit optimal credit policy, our inventory also have a optimal policy, right? So whenever we have increase in as the size of the order increase, right? Meaning that each time we order the inventory, we order bigger bulk, right? Whenever there's a more inventory that we order, there'll be increase in carrying costs, right? When we order more inventory, it means that we need more space, means that there's more warehouse costs, so there's more cost involved in carrying the inventory. At the same time, by ordering more inventory per order, we reduce the restocking cost because we order in bulk, means that we maybe order instead of 5 times a year in bulk, we now order twice a year. So every time we order less number of times, we save in terms of shipping costs, we save in terms of delivery costs, etc. Right? So whenever the size of the inventory increase, the restocking cost decrease. Again, similar to our optimal credit policy, there is an optimal level where the carrying cost equals to the restocking cost, and this will give us our lowest total cost of carrying the inventory. And this point here has a special name. It's called the optimal cost of carrying, where the carrying cost equals to restocking cost, and this level is called economic order quantity. So there is a official definition in the next slide, but this is called EOQ, economic order quantity. Now, like I mentioned, the economic order quantity, EOQ, is provides the optimal order size that you need to make, the best demand. And the EOQ is given by this formula here, where it is the square root of 2 times the total units still sold per year. So I highlight here the units are very important, per year, times the fixed cost per order, so per order, divided by the inventory carrying cost per unit. So all these are very important. Where is it? It's per year for the total units sold, fixed cost per order, and the inventory carrying cost per unit, right? So you just take a square root of this times this. So in your final exam, lucky is an open book, so you do not need to memorize this formula, but you need to know this formula exists. And last but not least, we need to also know that the total inventory cost is a aggregate of the total carrying cost and total restocking cost, and the carrying cost takes the quantity purchased divided by 2 times the carrying cost per unit, and then the restocking cost takes the total sales per year divided by the quantity purchased times the fixed cost per unit, right? So we will have two examples to illustrate to you, so do not worry on how to use this formula here. Okay, so this is very important. So again, this kind of question is very standard. You will see in the two examples how it's being tested. Okay, so before we move on to this example, let's again take our second break. We'll be back in around 6 minutes, maybe 9:10 to 9:11. So we again, we like to take two breaks. So let's take our second break before we finish off this lecture. Okay. All right. Welcome back. So, last part of this lecture. So, let's look at an example of how we calculate the economic order quantity. Right. So, we have this example here where the inventory, considered inventory item, which the carrying cost is 1.5 per unit, fixed cost is 50 per order, and the firm sells 100K units per year. Right. So, given that we have the formula already, where I'm just going to flip back, where EQ equals to 2 times T, which is the total units sold per year, multiplied by the fixed cost, divided by the carrying cost per unit. So in this example, we are given all the answer rate, 2 times the um, sales per year, multiplied by the fixed cost, divided by the carrying cost per unit. So we are just able to determine the economic order quantity. And remember the meaning of economic order quantity, right? The meaning of it is that it is the optimal amount of order you should make per year. Means what? You should make an order of 2582 units per year, such that our carrying cost and restocking cost is exactly the same here, which gives us our lowest cost, right? This is the optimal level of units ordered per year in order to have minimal cost. So that's the meaning of the economic order quantity, right? Optimal size of order, as we have seen here, optimal size of order. Okay, so optimal size of order in this example is 2582. Now, let's look at another example. No, not an example, but the same example here, right? So, having calculated the optimal, so having calculated this, right, the optimal order that you should make, let's determine based on this optimal level of order you should make, what is the carrying cost and what's the restocking cost, right? Recall in the example that the carrying cost is Q, which is the quantity that you purchase per order. In this sense, you use the EOQ, which is the 2582 divided by 2 times the carrying cost of 1.5 as given here. Our carrying cost is this 1936.5. Now, our restocking cost is the um, total number sold divided by the Q, which is the optimal EOQ that we have calculated, which is 2582, multiplied by the fixed cost per unit, right? And we get this. Now, I have a question for all of you. Why is the carrying cost the same as the restocking cost? Anyone? Why is the carrying cost equals to the restocking cost? Yeah, okay. It's the optimal level. Is the cost the graph intersects. You're right. And why? Because the Q, so the Q that we use here is the EOQ, right? Optimal order quantity, which we have calculated here. Can you see? So that's why it is the optimal level. So you are totally right. So this, and so the total is just add both up, right? So add both up. This is the total inventory cost. Now, this is the first example where we actually use the Q, which is the economic order quantity. Now, we have one more example here. Let me see. Okay, just a bit. We have one more example. Actually, you know what? Let's do the example first. Let's skip all these questions. Okay, let's do this example here. Then we'll go back to that qualitative part. So we have this example here, and note that you are not using the economic order quantity here. So let's read what does this question say. Okay, so Plaid Off Manufacturing uses 1150 features assemblies per week. Per week. Okay, it's important, it's per week. And we order another 1150. If the relevant carrying cost per switch assembly is 5.5, fixed cost is 625, is the company's inventory policy optimal? Okay, so in this case, let's work out the same thing. So we know that this is a per week basis. Recall that I mentioned earlier that for this EOQ, it is very, very important that you're using it on per year basis, right? So since the question gives us per week, we need to multiply by 52 weeks as given here to get the number of orders per year. Okay, once we have obtained the number of order per year, we can actually calculate the EOQ, right? So our EOQ, given the formula, will give us around 3687. It means that based on this EOQ, which is the optimal level, we're supposed to make how many orders per year? We're supposed to take 59800 divided by 3687 gives you 16 orders per year. Now, the question is, currently the company is making an order size of 1150, right? It means what? This order size of 1150 is not optimal. So we need to increase our order size to 3687. Secondly, we need to decrease our number of order in order to reduce the restocking costs by reducing the number of order from 52 orders per year to 16 orders per year as we have calculated here in order to make it optimal. So to answer the question earlier, inventory is the inventory policy optimal? No, it's not optimal because this is what we have to do to optimize your inventory policy. Now, let's say we just use the non-optimal quantity, which is Q, given the question to calculate the carrying cost and restocking cost. Now, this 1150 is a non-optimal quantity purchase, and we calculate the carrying cost as this. Again, we use the non optimal quantity of 1150 to calculate the restocking cost, and we get a restocking cost of this. Can we appreciate now that you notice the total carrying cost and the restocking cost, they are not equal, which means that the firm's policy is not optimal since the carrying cost is not equal to the restocking cost, which is this point in the graph here, where you have the lowest total inventory cost. Any questions on this? So you see that the second question is using the non-optimal quantity purchase Q to show you that the carrying cost and the restocking cost are not equal, and that's why it's not optimal. The first question actually uses the EOQ to calculate the total carrying cost and the total restocking cost and prove to you that by using the EOQ, our total carrying cost equals to your total restocking cost, and this gives you our optimal inventory level. So in your final exam, please be very careful what the question wants, right? Read the question carefully. Are they requiring you to determine whether the policy is optimal, or are they asking you to use the EOQ to show that the carrying cost equals to restocking cost when you purchase at the EOQ level? Okay, I guess there's no any other queries. If not, we'll go back to the theory part on EOQ. Okay, so maybe you can just think about it. If there are queries, feel free to put it in the group chat. Let's just think a bit more theory on EOQ, right? So in EOQ is the optimal level that we have. What we can extend further is that we can include this thing called a safety stock, which is the minimum amount of inventory on hand, and the point that we're going to reorder each time, right? So let's look at this example here. So the safety stock means what? This is the minimum stock that you must have on hand. And every time your inventory cannot go below your safety stock, right? So it always go up and down, but it cannot eat into your safety stock. Now, on the other hand, we have the reorder point. Reorder point means what? It means that whenever you dip to this point here, you need to start ordering because this will have some delay in terms of delivery. And so it allows time for the inventory to reduce to zero, and then you reorder again. So again, at this point here, you need to reorder, then it goes up, right? So your reorder point and your safety stock can be combined together, as you can see here. So this is a safety stock. So whenever the inventory go to this point here, you reorder, so you dip below here, but it never goes below the safety stock and it goes up again, right? And then it dips down again, and then you reorder here, and then it dips and goes up again, right? So this is the point. So in terms of your inventory management, it can be related to a computer-based kind of ordering, scheduling kind of system, or increasingly most companies like to use more of just-in-time policy, where you just purchase and order based on requirements uh, in the inventory. Okay. So actually, that's all I have for the lecture in terms of the coverage. Um, I would like to say congratulations on and going through all the content for this module. Um, I know it's not easy, especially because we have a mixture of finance to the non-finance and some, especially for non-finance. I understand this module can be quite challenging because it's very quantitative, and the content can be very heavy. So congratulations on completing it. Any questions at this point in time? So I'd like to open up for any queries, whether it's general or more specific. It can be relating to content we've covered, or maybe you have some general questions relating to your final exam, which will be a couple of weeks. Yes. Yeah, handwritten. Yeah. So it'll be handwritten. So from what I understand is that you have to write it in paper, and for markers, we have to collect the physical script and mark it. Yeah. Yeah. So you can use your Excel. Um, okay. So one point I want to highlight to you is that I noticed in your GBA, some of your groups, right? You all use, like, let's say, time value of money. You use the formulas and all those things. I want to encourage you to just put the Excel formula. So do not need to put all your bracket, I don't know, to the power of what, to discount, compound, all these things. Please, because in your final exam, you will not have time to write all those formulas, right? Please use the shortest method. If you can use Excel and just write, I don't know, MPR equals to what, PV equals to what, FV equals to what, you get an answer straight away, just write that. You do not need to write the mathematical formulas. Okay? Yes. So your final exam will be something like your GPA. Yes. Why liquid asset brings low return? So whenever you have more liquidity, means what most of the time when we talk about high liquidity, means that you have cash, right? And you have a lot of cash in your bank. It does not generate money for you. That's why there's low returns. right? So you generally do not want to have too much cash in your bag. Yeah, I think it's one device allowed. I believe it's only a laptop. So please look at the announcement, but there is no phone that is allowed. So you cannot say you want to use your calculator or your phone. You only can use your laptop, and it is locked down, and you basically use your laptop like a calculator in the form of Excel. Uh, yes, I think you can bring. Um, but please look out for the announcement. I believe you can bring, but then you must use your Excel. Okay, so I heard last semester that your Excel sheet must be a blank sheet. So you cannot so-called create like a, I don't know, amortizing table in your Excel already, and then let's say use the amortizing table and just plug in values. So you cannot do that. Your Excel that you use for exam must be a blank sheet. That's what I understand. No, so the whatever that is done in your Excel is like a calculator. So imagine your Excel being a calculator. So only things that you write on your physical paper will be marked. So your Excel will not be marked at all. So please use your Excel like a calculator. You do not need to format it very nicely. Use it as like a calculator for yourself. Okay. Yes, it's an open book. Right. So again, I repeat, whatever you have done in Excel, it will not be marked. Maybe they ask you to submit it, but then as a marker, they will only look at your physical scripts that you have written. Oh, really? You saw close book? Yeah, you can bring handwritten formula sheet if it's open book. Yeah, I think it's open book. Uh, yeah, I believe it's open book. It's open book. I believe it's open book. Please again look at the announcement provided by the school. Of course, whatever they say is final. They might have some changes, but please look at it. Um, if your notes are in Excel, I'm not sure whether you can do that. I think you need to use physical notes. And because they have a lockdown browser, I'm not certain that you can use your Excel other than the blank Excel sheet. Yeah. So if you do have queries on that, please write to the school. But from the last exam, the feedback that I received is that Excel that they use have to be a blank Excel, meaning not a pre-made Excel, nor can you use like I don't know a pre-formatted Excel and then you use that Excel. It cannot be used. I think they will check. Probably they'll check before your exam. As I mean, the examiner will walk around and then look at your Excel sheet, right? Of course, and it's quite obvious. Sometimes you let's say pre-formatted Excel, it'd be very nice, right? Like your header and everything. They obviously know you have not. If the exam started in half an hour, you have no time to format everything so nicely for Excel. So yeah, just yeah, you don't want to be of course caught and then jeopardize like your grades for this module as well, right? So yeah, so don't format it. Okay, regarding on whether the notes have to be printed out, please reach out to the school on that. Whether to confirm whether you need the notes to be printed out or can you use like a digital notes. Yeah. Yeah, so I don't want to give you the wrong information on the notes part. Please reach out to the school on that. Yeah, so we don't have conflicting information. Yeah, I think your devices have to be offline. But remember, you cannot use your phone. You cannot use your phone. Yeah. Uh, let's see. Do we have any more specific questions?
Hey, Prof, I have a question.
Yes.
It's on slide 17-8. Sorry, I
Sorry,
have
can you repeat again? You were breaking. I couldn't hear.
so I have a question on the slide 17-8 on the practice question.
And
So I was
slide
reading the question
17 dash 18, is
at
it?
8,
This one?
8, 17-8, practice question on the EAR and APR.
Okay, this one. Okay, yeah.
Yeah. So I was rereading the question. Is there a typo in the question?
Which part is a typo?
It says what is the implied interest to your firm is a customer chooses the advantage. So are you the customer or are you the firm? Sorry, just very silly, sorry.
Oh, I think this is if. This is not is. If. This is a if. I have.
Okay,
So
then
what is the impact?
EAR is the one that tells you if you should take the discount or not, right? But what does
Yes.
APR bring to the firm?
So because the APR is the just the nominal, and what we are interested in is actually the EAR. Why we use EAR instead of APR to compare with the cost of capital? Remember what the meaning of EAR? So EAR is the effective rate as if the compounding of the rate is per year basis, right? Compounded per year. Now, your APR is the rate that is being compounded based on the number of compounding periods in a year. So it might not be compounded once per year. In this case, is compounded 365 divided by 60 minus 15 number of times per year. So if you want to compare which rate to take, you must compare based on the EAR because it's assuming a compounding of once per year. Does that answer your question?
Oh, got it. Thank you.
Yeah, most welcome. Do you have other questions? Okay, so maybe at this point not much question. So I'll encourage you to also practice the past year paper. As you know, probably other modules as well, quite similar to this module. We cannot provide you model answers for your practice paper. However, if you have specific questions as you're practicing the past year paper, you can drop me an email. Usually, I think most of you all know I reply emails quite quickly, and then I can advise you accordingly. Um, if you provide the solutions already. So for example, let's say in this practice question is one of the questions in your past year paper. Let's say you have worked out all this stuff and then you just not too sure about certain things, right? Then you can say, oh, this is my working. I'm not too sure about this part. Can you help me on this specific part? For me, I can answer questions like this. I can provide you the solutions like, oh, this part you're wrong, this part you're right. However, as you know, the school is quite strict. We cannot provide you, like let's say you say, oh, how do you do question 2A? Yeah, unfortunately, I cannot answer that for you because we're not allowed to provide you model solutions. But if you have worked out question 2A and you feel that something is wrong, you feel free to reach out and I am happy to help you to see whether it's right or wrong. Okay. One more point also, after today's lecture, I'll be releasing also your class participation marks. And so this would means that you have now all your continuous assessment marks, your GPA, your class test, and your class participation. So this will allow you to gauge, how much maybe effort you want to put in for your finals. Because I know many of you are also working full time, or you have other modules as well. So you can, optimize your effort accordingly, right? So I'll post your class participation marks so that it allows you to prepare accordingly based on, how much you want to score at the end of the day. Okay, so actually the main part I want to go through is any questions, so that's the key. However, I'll take some time to just go through these discussion questions on MPV. As you know, MPV is one of the key topics that is most likely will come out in certain form, shape, in the final exam, because it's the topic that has been tested the least. And so please be ready, I would say, to do your MPV questions. Really focus on practicing MPV questions, because in some shape or form, I'm pretty sure something will come out, particularly coming out with the CFFA, right? So if you forget what's a CFFA, please review the lecture that we went through. How do we determine the CFFA? Because if you notice, even for your GPA, that have not been tested, right? How do you determine CFFA? Okay, so in the interest of that, I would like to just go through a few questions. I might not cover everything, but the good thing is that the workout solutions are fully provided to you. So I really encourage you to go through these examples, because they will allow you to understand how do you do determine CFFA. Okay, so let's just look at the first example. And if we do have any questions, we will pause and we answer questions, as well as any other questions, whether it's general or specific to other topics as well. Alright. So, these questions are important. So let's look at this discussion question here on CFFA. So suppose we have a project evaluation that we have to do. The revenue generated by this new project is forecast as such, right? So we're given the revenue forecast. Revenue is 40K first year, 25K for second, third, fourth, and then thereafter there is zero revenue. Question: is revenue equals to operating cash flow? No. Okay. Yeah. Please. It's not. It is not. Okay. Okay. So we just have revenue. Now let's look at the other example. Other information. Expenses are expected to be 40% of revenue, and working capital requirement in each year is expected to be 20% of revenue. Okay. So expenses 40%, working capital 20%. The product requires an immediate investment of uh, 45K in plant and equipment. If the plant and equipment are depreciated over 4 years to a salvage of zero using a straight line depreciation, there's a firm tax rate of 40%. Okay, so now the question is project the cash flow. So this is your CFFA that I was talking about, that you need to know how to project, and then do calculate the MPV and IR. Okay, so I do see a question that is directed to me, but I'll answer it for everybody's benefit. So, in terms of theory question, the exam, is our slides good enough, or do we need to look at study guide and textbook? So, I want to say that the slides that provided in our tutorial group is more than sufficient to cover any theory questions in your exam, as well as you notice it's more than sufficient to cover your theory questions in your GPA as well. So do not worry, you do not need to go to your study guide and textbook to study. Just really focus on our slide materials, and you will be good for the exam. Okay. So we know that revenue is not equals to operating cash flow. So let's calculate the various items here, right? So first thing, easiest thing to calculate depreciation. So we know that it's on straight line basis for 4 years with zero um, book value at the end of the year. So we get the depreciation. We have determined that revenue has been given here as such 0, 1, 2, 3, 4 as given here. So we know that they say the working capital is 20% of revenue. Okay, let's look at expenses are expected to be 40% of revenue, and working capital required in each year is expected to be 20% of revenue of the following year. Okay, so this is important. Following year. Okay, so what does this mean? It means that in year zero the year zero working capital is 20% of the revenue in year one, right? As you can see here. That's why there's some working capital in year zero. Then year one is the year one working capital is the revenue in year two. Then year three is the working capital in year four, right? Like this. And year four working capital is 0. 40K. 40K is the revenue. So remember the question gave us the revenue here? Yeah. Okay. So we have calculated the working capital. So this working capital is given like this. And so we can also calculate the operating cash flow, right? Earlier we mentioned that operating cash flow is not equal to revenue. So we must calculate operating cash flow where we are going to use the tax shield method. Right, so tax shield method utilizes the revenue multiplied by the 60%. Here, 60%. Why you multiply 60% is because they say expenses are expected to be 40% of revenue. So if 40% of the revenue is expenses, the other 60% is the gross profit, right? Which is what we want. Sales minus cost is gross profit, which is what the tax shield method want. And so this 60% is your gross profit, which we calculated here, multiply by 1 minus tax, plus the tax shield that you get from your depreciation. So this is your GBA question 3B, right? 3B, question 3B was asking on this aspect of it, on the tax and the depreciation. So if you use the tax shield method, we can easily see that depreciation actually provides a tax shield for you. And this gives you 18,900 in terms of operating cash flow. You have to calculate operating cash flow again for year 2 to year 4 because our revenue is slightly different. It's 2,500 for year 2 to year 4. Okay, so you have two operating cash flow here. Now, let's put all this in a table, right? So please be very clear whenever you do your exam as well when you put this in a table. So let's start off with this, right? We have initially a fixed asset that we have to purchase. So I'm just going to flip back here. We have mentioned, right, investment of the plant of 45K. So we have to purchase this at 45K here. And at the end of year 4, there is not going to be any salvage value as given in the question, zero salvage. So we do not need to consider after tax salvage. Now, in terms of operating cash flow, let's look at operating cash flow first. Operating cash flow we have calculated here already. These two figures for year 1, year 2, 3, and 4. So we are just plugging it here. This is the easy part. Right. Now, this question is very tricky on the negative change of working capital. Okay, let's flip back to see the working capital here. So in year 0, can you see that there is year 0 you have incurred 8,000 working capital. Now, what is the change in working capital in year 0? Anyone like give a try? What is the change? No, the change, not the negative change. What is the change in what in year 0? So it's 8,000, right? Because in year zero, it has increased to 8,000, right? In year zero, it has increased 8,000. So the change in working capital is 8,000. The negative change is negative 8,000. Okay. Now, flip back to here. Again, in year one, what is the change in working capital? Can you see the change in working capital is minus 3,000. You're right, minus 3,000. Okay, I hope everyone can see minus 3,000, because your working capital has decreased by 3,000. So, because your working capital has decreased by 3,000, your change is negative 3,000, but your negative change is positive 3,000. Okay, so this is very important because what we want in CFA is negative change, but always start with change, then put the negative later. If not, you get confused. Okay, now from year one to year three, what is the change in working capital? Zero, correct? Means that negative change is zero. Okay, now recall that in our lecture, we mentioned that there's this important concept of recovery of net working capital. Now, this recovery is what is being seen here. At the end of the project in year four, we need to ensure basically what's the recovery? Basically, need to ensure that your total here of negative change must be equals to zero. So this thing becomes a positive 5,000 to ensure that the whole negative change in working capital becomes zero. This is an important part, is usually the trick or the trick in the question where you need to be very careful. If not, you'll be tricked because you'll omit this 5,000 at the end. Again, I repeat that this 5,000 it is assumed that you need to know that there is a recovery of working capital at the end of the project, right? And again, I want to repeat what is this? Why is there this assumption, right? Let's just think about it logically again. So, working capital is used for daily operations, right? So, at the end of the business or end of the project, we do not need these funds for operations anymore because the project has ended, right? So, in technical sense, we should be able to reverse any working capital that's being used in the business, right? I hope you can see this kind of play that's involved, right? We're just reversing any working capital. So net basis at the end of the whole project, there should not be any working capital. There should not be any negative change in working capital. So everything must be equal to zero. That's why we have a recovery here. Okay, any questions? So I'll just pause here. Any questions relating to this kind of CFFA or general questions? Okay. If there's no questions, I would like to do this example. One more question, and then I'll leave question three for you to go through on your own. Okay. So let's just look at one more example here. So we have a project, okay, requiring an initial investment of 10 million. The equipment may be sold for 2 million at the end of 5 years. Now, this is the salvage ready, so we know there's a salvage involved. The company applies a straight line depreciation over 5 years to zero. So at the end of 5 years, the book value equals to zero. So again, I hope you still remember what's the difference between book value and salvage value. So if you do not remember, please review the lecture again. The company expects to sell 750K pounds of product a year. Price is $20 per pound. The total expense is 10 million. Accounts receivable are 1/6 of the revenue. The inventories are 15% of the following year's expenses. Okay, tax rate is this, discount rate is this. Okay, so once we have salvage value, please do the necessary calculations. First, we always start off with calculating depreciation. We know that we are depreciating to 0 as given in the question for 5 years. Now, we need to calculate after tax salvage. In this case, we need to, if you notice, even though we can sell the item for 2 million salvage, but at the end of the day, the after tax is less because we have to pay tax expenses on our value that we get out of the salvage, right? So we need to pay tax of 35%. In the question, they say, what did they say? The accounts receivable are 1/6 of revenue. So accounts receivable are 1/6 of revenue. So we take 750K times 20. This is the revenue divided by 6. This is your accounts receivable. Your inventory is 15% of, let's say 50% of what? 15% of the following year's expenses. So we know total expense is 10 million. So your inventories will always be 1500, 1.5 million, but it's the following year. Okay. So after you have done this, we can calculate what is the operating cash flow. And again, we use the tax shield method. So we take the revenue minus the expenses times the tax rate, 1 minus tax rate, sorry, plus the tax shield that we get from our depreciation here, right? Calculate operating cash flow. Okay, so on this front, now let's put in the values here. So we have purchased a fixed asset in year 0. This time, unlike the first question where there was 0 salvage, this time we have after-tax salvage in year 5, right? Recall the project ends in 5 years. Okay, the project ends in 5 years. So we have after-tax in year 5. Now, again, let's look at the operating cash flow because I think it's simpler. We have calculated operating cash flow quite standard. It's just a fix of 3,950K. So this is standard for the 5 years, it's just that. Now, this question again is very tricky on the negative change in working capital. Right. So let's look at the question again. The question says accounts receivable are 1/6 of revenue. So let's tackle this part first, right? So we have calculated the accounts receivable as 1/6 of revenue given by here, right? Accounts receivable 1/6 of revenue, which is 2.5 million. So these are the accounts receivable. Accounts receivable. Whenever there's revenue, there's accounts receivable, right? So these are all 1/6 of the revenue here, right? Okay, so it's kind of clear. Now, let's look at the inventory. So question says, inventory is 15% of the following year's expenses. What does this mean? It means that the inventory in year 0 is 15% of the expenses in year 1, right? And the expenses every year is, what's the expenses every year? 10 million, right? So in year 0, there's going to be an inventory involved. There's year 1, there's going to be inventory. Year 2, there's inventory. Year 3, there's inventory. Year 4, there's inventory involved. In year 0, so in year 0, in terms of the working capital, change in working capital, what is it? Is it a positive 1.5 million or negative 1.5 million? Change in working capital. Positive, you're right. It's a positive 1.5 million change in working capital. Now, the negative change is negative 1.5 million. Now, from year 0 to year 1, what is the change in working capital? Year 0 to year 1? That's right. So it is a positive 2.5 million. The negative change is negative 2.5 million here. Now, from year 1 to year 2, I think this is easy. There is zero change in working capital. Zero change again. Zero, zero, right? All zero change in working capital. Now, in year 4 to year 5, year 4 to year 5, now you can see that the change in working capital is negative 1.5 million, which means the negative change is positive 1.5 million. The difficulty in this question is the part year 6. Can you see that even though the project ended in year 5, there is still a working capital in year 5, right? So in year 6, now there's no more working capital because the project ended. And so from year 5 to year 6, there's going to be a change in working capital of negative 2.5 million. Again, repeat, from year 5 to year 6, because the project ends in year 5, there's still working capital in year 5. So in year 6, it's going to all become zero. So the change in working capital for year 5 to year 6 is negative 25 million. And it means that the negative change is positive 2.5 million. Any questions on this? Why is there a year 6 that appear even though project ends in year 5? Okay, so I want to just highlight to you this is very important because this question is very tricky. Even though they say project is within 5 years, you do have to consider the 6th year simply because on the 6th year you have a recovery of your working capital because the working capital decreases from 2.5 million in year 5 to 0 in year 6, right? So you need to consider year 6 even though project only ends in year 5. This is the trick to the question. Once you identify this trick, you just add everything up, meaning you add this, add this, add this, add this, and you just calculate accordingly the NPV and IRR. I think that's all I'd like to cover today. Any other final words, any questions before we say say goodbye? It has been a nice very nice 12 weeks of getting to know each other. Hope you have enjoyed the lesson. Um, it can be, I know it can be quite tough, but I hope that this would spark your interest in finance. Uh, yeah, I think finance is quite fun. Tips in revision, really focus on the lecture slides. Those are really sufficient for your exam. Yeah. So do not worry. You do not need to go searching for other content in the study guide. Just focus on lecture slides. And also encourage you to practice the various self-review questions. So those are quite important as well. Thank you. Thanks for the nice words. Yes, I really hope everyone can get through this module. I know because I understand sometimes like most of your, I would say, yeah, finance is not your major. So this is of course one of the requirements for um in order to go to the next level, whether you are in human resource or supply chain, etc. Unfortunately, this is one of the mandatory modules. So really understand that it's not it might not be everyone's cup of tea, right? Because sometimes you might not be very interested in finance, which is totally fine, but this is a requirement. So yeah, really glad that hopefully you can understand this module. And maybe some of y'all might be interested in other finance mod. So I do teach, other finance like core modules or finance related modules. So in case you're interested, like equity and stuff, then you might still see me around. Yeah. What is A and L modules? What's A and L? Oh, uh, no, so I don't, but actually I used to do analytics in my job scope. So used to do a lot of Power BI and big data modeling. Maybe they'll put me to teach that in the future, but at the moment, no. I'm focused more on like pure finance models. Yeah. Yeah, don't worry. I understand this module can be quite tough. I think overall, like I said, I'll release your class participation marks for those that have been actively participating. I think there's nothing to worry. Most likely you will get 80-90% of the marks. So it allows you to also gauge how much effort you can put um, in your final exam. Of course, you need to optimize your studying as well because I understand most of you have multiple modules. Some of you are also working, so try to optimize it accordingly to get the grades that you want. Okay. And yeah, again, I just want to thank you everybody for the 12 weeks and the 6 lessons. Really enjoyed teaching all of y'all. I really hope to see y'all again in other finance module, maybe the physical module. Just in case, if you do take any physical module that I'm teaching, in case I can't recognize you because it's online, so I only see the names, I don't see the face. So do say hello and let me know that you are in this module, and then I'll probably remember, right? Okay, so I do not want to take more of your time. I know it's a weekday, it's a Monday as well. So all the best for your finals. Again, if you do have any questions or if you're preparing, like practicing your past year paper, do not hesitate to reach out to me by email. I'm usually available, I reply email pretty fast. And again, if you're practicing your past year paper, I want to highlight that at least you have to give it a 10, and then if you have questions, I can help you with it. Unfortunately, we are not allowed to just provide you answers for the final, for the practice exam, right? So that's usually the approach. So try to practice it if you like. Have any questions, you can send me your working, and then I can review it, and then we can try to remedy any questions you have. Right. So thank you. Let me just pause the recording.